Hey, this is the time of the year where Canadian banks report their earnings. So over the past 2 weeks, they have reported their Q1 2022. My name is Mike Yahoo. I'm the founder of Dividend Stocks Rocks, and I'm a passionate investor. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. So give me a thumbs up, like this subscription to not miss any updates. And today we're going to talk about one of my favorite topics, Canadian banks. We're going to talk about earnings, we're going to talk about dividends, and we're also going to talk about some big news that happened over the quarter. So let's get started with the earnings and the payout ratio. Obviously, all Canadian banks increased their dividend last year at the end of the year of 2021. So it was just normal to not expect any dividend increase this quarter. But what is interesting here is that we had the two banks that outperform all the others during Q4 are still doing it in Q1. So we have BMO and National Bank with earnings per share jump of 27% for BMO, 23% for National Bank, and their payout ratio 34 and 33. So in general, they were the most generous, and they still are going to increase their dividend probably among the top three for this year. Both banks are doing very well in all aspects. We're going to deep dive into all the segments in a second. Just want to highlight that the regular performance out of the big six was pretty much like double-digit increase, like TD, CIBC, and Scotiabank. Like they were all at plus 14, and the payout ratio should be around 42%. So we had Royal Bank in terms of earnings that lagged behind. We're going to see why. So plus 7 is good, but it's not as good as all the others. And Scotiabank payout ratio at 46%. So obviously no concern here. 46% is a lot better than most companies, so you don't have to worry. You're still going to have a mid-single to high single-digit dividend increase for Scotiabank this year. But just to highlight like where they are all positioned, you can see that BMO and National Bank are definitely way ahead of the competition for a second quarter in a row. So let's now deep dive into results per segment for each bank. So as you can see for BMO, very strong performance for the personal and commercial banking. Same thing in the US and capital markets. I keep telling you guys, capital markets are amazing, but they are highly volatile. So sometimes they're going to bring the entire business up, and some other times it's going to bring it down. In this case, BMO did amazingly well, plus 47%, and this is why they have done so well overall. Small source of concern, wealth management was down 8%. Which is not that great. You have to follow that, but obviously from one quarter to another, sometimes you have like big clients coming in making a lot of money. The next quarter it's not the same thing, so it's kind of normal that you not always grow in this segment. For National Bank, everything was pretty much straightforward. This is what I like about this bank right now. It's the consistency across all segments, so double-digit growth everywhere except international. For US specialty and international segment, we're up 9% and still very good performance overall. For TD, we got double-digit in Canada, almost 30% growth in the US. Charles Schwab's integration was up 21% this time. So wholesale banking at minus 1%, so nothing to worry about here, but still that bring the results a little bit lower. For Royal Bank, as I mentioned, this is the bank that hasn't performed that well this quarter, and we can see investor treasury minus 4, capital market minus 3, entrance minus 2. So at this point, it's a little bit harder for several segments. We have seen that insurance business hurt Royal Bank, but also worked BMO. I forgot to tell you that. But the reason why wealth management was down is they include insurance, and they had like a bad quarter, and this is why it's dragging down as well. So sometimes diversification is good, sometimes it's also a break to your growth. For CIBC, it was a very good quarter. Personal and commercial banking up 5%. Wealth management 31 in Canada, 20% in US. So they did very well. And then capital markets up double digit as well. So overall, a pretty good quarter for CIBC. This is not my favorite banks. Usually I find it pretty much boring. But you can see that right now they're still growing well for commercial and wealth in the double digits. So it could be interesting going forward. They're still offering a very generous yield. So that's also another plus for them. Finally, Scotiabank, the bank that I don't like that much, mostly because of its exposure to international market. Everybody says, oh, Scotiabank is like the international bank and it's great for diversification. It's like a double-edged sword, and most of the time that narrative is very interesting on paper, but it does not translate into a lot of growth. This quarter, actually, it went very well, plus 38%, and then plus 32% for personal and commercial loan. So overall, another good quarter for Scotiabank in general as well. As a summary, all banks went with more loans, more deposits, and lower provision for credit losses. So that explains also part of their growth. Moving forward, some banks are taking action. So that was a very interesting. First thing is TD is going to acquire First Horizon, a regional bank in the US, for $13.4 billion or $25 a share. This is supposed to be accretive right away. So meaning that as soon as they acquire First Horizon, TD is going to make more money right away, right up front. The transaction is expected to close in 2023. And it's pretty much aligned away with their overall strategy, meaning that they want to expand in the US. They've done well so far. 1/3 of their business is actually down south, and they keep on going this way. So they see a lot of potential with the US market. They have this recipe that works, so I think it was a great deal for TD. Now for BMO. BMO has been quite busy. What they did is that they're actually selling some of their asset management, private banking stuff to Ameriprise Financial. So that is like more offshore business to actually shift around and acquire Bank of the West in the US for $16 billion. The idea is pretty much similar to TD. They want to expand in the US. They see a lot of growth over there. So this transaction should bring in $57 billion in loans and $90 billion in deposits. So that it can tell you as well that Canadian banks right now are showing very strong balance sheet. They are able to make massive moves. I mean, we're talking about transaction over $10 billion each. And it's not going to affect their balance sheet that much. That's the best part, right? So they have strong payout ratios. Dividend increase should come in 2022 without any worries. And on top of that, they make sure that they found growth vectors elsewhere. So definitely very good news for investors. Now we have some other random news, such as CIBC that the board has approved a 2-for-1 split. And if this is approved by at the shareholders meeting in April, it should happen on May 6th. They want to split those shares. My opinion on splitting shares, not making much difference, to be honest. If you in this case, let's take a look at what's going to happen with CIBC shares versus it peers following the next 6 months after May 6th. So maybe we can revisit that in December for the latest quarterly earnings that I'm going to do on this channel. But honestly, it's not going to change much. So if you're doing DRIP, so dividend reinvestment, this is great because it enables you to buy more shares rapidly. But that's pretty much it. I mean, before that, you had like one piece of the pie, and now you have two smaller pieces of the same pie with the same place. So it's not going to make a big difference. I'm not overly excited about that. I know that like some investors love it so much, but I don't think that CIBC will outperform other bank stocks just because they do a split and the other banks are not doing. Another random news. We all know what happened in Ottawa in February. The Liberal government went and say, you know what, this is a state of emergency, and now we're allowing banks to freeze assets. And I don't want to go into politics. I'm not going to debate what they did, why they did it. I mean, that's has nothing to do with investment. But some investors, some readers ask me, well, don't you fear a bank run? Meaning that if banks can seize your assets, maybe that a lot of people will just cash their money and then run, I don't know, into the woods and put that in a black box or somewhere under their mattress. I'm not afraid of that. I don't think it's a concern because you know what, even though they have the right to freeze your assets, it's pretty much like this thing that, you know, they have the rights to go into court and seize your property if you're not making payments and stuff like that, but they're not in that business. Actually, banks has nothing to do to freeze your assets, and unless they're forced and unless they have like very strong reason, they're not gonna try to police everybody and then look into their bank account and then freeze them just for fun. Maybe we're gonna see a few cases here and there, but it's not going to affect the bank stock price. We have seen that upon the news, bank stock price didn't move. I don't think they're going to move anytime sooner. So don't expect those like flashy news to impact the overall business. How many people do you know that they have actually sold their entire RSPs and cashed them, paid their taxes to buy like gold and put that in their basement, right? I don't, those like apolitical scenarios are not necessarily something that I consider as a long-term investor. So I think that this is it. I mean, you know, you can agree or not about how it was handled and how this the convoy was handled, but that has nothing to do with investment, and I'm not going there at all. Finally, we have interest rate hikes. So Bank of Canada increased their interest rate by 50 points, and then people are just like, oh my god, 50 points, what's gonna happen? Well, when you think about it, on a 100K mortgage, I did the calculation just for fun. So monthly payment over 25 years. So 3% is like 473, and then 3.5% is like 499. So we're talking about 26 bucks. So it's pretty much like your weekly latte at Starbucks that you have to skip if you want to keep your mortgage. I think that most Canadians will be able to take that, and also consider that it's been a while now. It's been several years where Canadian banks have to qualify you on the 5-year rate, which is not negotiated. So usually if you end up paying like for a 2.5 or 3% mortgage rate, you qualify for a 5% mortgage rate. So in this case, they have like a very large cushion in terms of qualification. So I'm not too worried about that. I don't think it's going to affect too much the housing market. Maybe we're going to reach a plateau, but that would be just saying actually, because to be honest, between you and me, the housing market in Canada has been crazy for several years, so it would be a good thing if it would reach a plateau and slow down a little bit. Now let's end up this video with one of my favorite graphs, because a lot of investors are telling me I can't find any value on the stock market. Well, there you go. Canadian banks trading at a PE ratio between 10.5 and 12.5. I mean, 12 times the earnings for a company that operates in an oligopoly, that offers like mid-single to high single-digit dividend growth year after year, that has several growth vectors. Dude, that's what you have to do, right? As you can see on this graph, we have National Bank and CIBC that shows to be the cheapest one around these days. To be honest, my favorite one, again, National Bank. I mean, I keep repeating myself like quarters after quarters, but I mean, they were number 2 in terms of earnings growth behind BMO, and now they're number 1 in terms of valuation. I can see that there's definitely something out there. BMO is doing very well for the past, like 12 to 18 months now, and yet they're still trading at a very attractive price. So if you're tired to listen to me about National Bank, maybe BMO could be interesting, but keep in mind, capital market, highly volatile. So that's up for that. Besides that, I mean, you cannot really go wrong with Canadian banks. As you can see, they're very strong. They show very good growth vectors. They had a great quarter. And I think that the interest rate increase will just improve their income. For the past few years, they had to count on lots of growth in terms of deposits and loan to make sure that they compensate for lower interest rate that they charge on their loans. Now they'll be able to charge a higher rate, and I don't think it's going to be a big thing in terms of bankruptcy so far. So obviously we have to follow that. Bank of Canada doing the same thing. Just have to look at the provision for credit losses, but so far they're getting lower and lower these days, so that's also a good news. So they're telling us, banks are telling us, the Canadian economy is doing well. You don't have to worry about it, and we should have another good year. So if you're looking for a safe haven, considering everything that is happening right now, Canadian banks should definitely be on top of your list. So I hope that you have enjoyed this video. Go down in the comments, tell me which banks that are you looking to buy this year. I think it would be interesting. Like, which one do you think is going to outperform? Is BMO is going to do the trick a second year in a row? Let's find out. Let's discuss among the community. I'm looking forward to read your comment and answer back. And until the next video, don't forget to stay invested.